warm and hearty welcome to this edition of the Nation Leadership Forum. As always, this is a platform that creates an interface between state actors, non-state actors, and the public discussing matters of policy concern. And tonight we are focusing on financing Africa. The subject is focusing deeply on the subject of sustainable taxation. Now, mobilizing tax revenue is the key in developing countries such as Kenya if they are to finance the required investments in human capital, health, energy, and other infrastructure necessary to uplift the citizens' social economic status. Unfortunately, tax revenue in Africa remains largely low, with a 2019 study by the World Bank indicating that Africa remains the continent with the largest number of economies below the minimum desirable tax to GDP ratio of 15%. In the financial year 2019-20, for example, Kenya raised 1.6 trillion shillings in tax revenue, representing 16.5% of the country's GDP, just slightly above the desirable 15%. A sound tax framework which enables a country to raise the highest tax revenue in a cost-effective manner is crucial for the welfare and development of the economy. Widening the tax net while ensuring there is equity, certainty, simplicity, and convenience in collection of taxes is critical for any government. Governments also have the headache of sealing revenue leakages. According to a 2018 study by the World Bank, on average, 25% of all total sales are not reported for tax purposes, creating an avenue for leakage of revenue. How can Africa best enhance the mobilization of revenue given the vast segments of the economy that are largely informal? How can Africa strengthen its efforts to seal revenue leakages and ensure optimal use of tax revenue? How can Africa better synergize mobilization of revenue from both state and non-state actors and crowd in private capital? To address this and more issues, I am joined on set by Atia Waris, who is a professor of fiscal law at the University of Nairobi, where she serves as the acting deputy principal for the College of Humanities and Social Sciences and also serves as the director for research and enterprise. Professor Waris has also written the book Financing Africa. I'm also joined by Maurice Ore, who is the Deputy Commissioner for Corporate Policy at the Kenya Revenue Authority. And also joining us is Christine Kahema Mudhui, who is the Director at Alpha Tax and Business Advisory Services. And finally, we're also joined by Robert Karanja, who is the regional lead for the BTeam, which champions tax compliance and is housed by Safaricom PLC. Ladies and gentlemen, welcome on set. And let me just begin by Professor Atia Waris. And before that, let me just mention that you can be part of this conversation online at NTV Kenya, at AmbokoJH. The hashtag is NMG Leadership Forum. Please give us your thoughts. We'll be happy to share them on set. Professor, let me start by the complexity that we normally face as African economies when it comes to the issue of the structure of our economies. When you talk about financing Africa and the large swath of the economy is largely informal, how do you mobilize tax revenue in such an environment?
So traditionally, what the governments have been doing across the African continent is relying on value-added tax. And the reason that they do that is because it's a very easy way to collect tax from one particular set of agents. For example, we have Safaricom here. So Safaricom collects VAT every time you use your phone on behalf of the person who's actually using the phone. But the problems with situations like that when it comes to the informal sector is that not enough attention is then paid on making sure that everybody pays income tax. And so in my 15-year study that resulted in my book titled Financing Africa, I immediately noticed some very startling statistics. For example, in Senegal, only 1% of the population are actually registered with TIN numbers. In countries like Kenya and Namibia, about 40% are registered. And these are very approximate figures. They're not even as clean or clear as they should be. And then on the other hand, you have countries like Madagascar with 3% and countries like South Africa that claim that 99% are on the tax base. And when you see data like this, then it means that the informal sector is not paying income tax, but government is taxing them through VAT and of course through goods and that they buy, customs duty. And it reminds me of an African proverb because I love them. And it says that rain does not fall on one roof alone. And so many people in the informal sector think they've escaped the tax bracket by not registering for taxes. But in actuality, they get taxed, but through other ways.
And Christine, just to pick up from where Professor is leading, definitely many governments would be latching on to the indirect taxes because that's where you reach the largest mass and of course you mobilize the most amount. Do you think this creates unnecessarily a heavy burden on the informal sector or those who are in the bottom tier of the economic pyramid, Christine?
Okay, so just to provide some context in this interesting conversation, Amboko, I just wanted to just mention something in respect to our budgeting process, because I think for me that's where the problem commences, because most African countries, how they do their budgeting process is that they develop the expenditure and then they look at ways of increasing income. And you will see this is usually the main driver for the taxes that they apply. And for me, as I listen to this conversation, I always wish that we can flip this, whereby we invest in looking at how to create a sustainable income and use that as a driver of expenditure. So from your question on indirect taxes, I think the informal sector becomes very difficult to tax because they find tax very complex. They find sometimes the Revenue Authority being very aggressive, which is actually driven by the targets that they have to reach in order to collect and meet the expenditure that is required. So that's why they try as much as possible and avoid or evade the tax base. Indirect taxes is easier for them because what happens is that everyone who purchases, for example, with the VAT, everyone who purchases is subjected to the same tax. Excise taxes may not really hit the informal sector because they wouldn't be dealing with goods that are subject to excise taxes. So they will mainly focus on the indirect tax VAT, and that may not really get the revenue the government needs for purposes of being self-sufficient from a tax perspective. And remember, Amboko, the informal sector actually comprises between 60 and 80% of the GDP. So if we do not come up with proper measures to tax this net, from a corporate tax, a turnover tax, and only rely on VAT, we will not be able to reach the targeted income that the government needs.
Christine, a quick rebuttal to you, and really in defense of the government. You've said that part of the challenge is our budgeting cycle, where we start with the expenditure side before we even think about the revenue. But in defense of the Kenyan government, we have seen a realignment of this, where for the first time ever, we have seen the finance bill coming side by side with the budget, essentially telling you that even as you think about the budget, these are the revenue measures we are proposing. Don't you think that's a step in the right direction?
It is, but I think we've mainly focused on the expenditure, and we really we don't put or invest as much as possible in driving the income, such that the sustainable income becomes the driver for the expenditure. Because, Amboka, that's the only way we'll be able to live within our means. Yeah. So if we're able to say, this is the cash flows, this is how I plan to raise the income, this is what I'm planning to do in order to increase the tax base, in order to reduce the revenue leakages. And then we say, based on that and the projected cash flows, I can develop an expenditure in line with that. Because anytime we focus on the expenditure, don't spend as much time on the income from an income perspective, we will see tax laws just coming in order to generate revenue, and those are very short-term tax policies. Tax policies should certainly be long-term.
Right, and Commissioner Maurice, to come to you, you sit at the Revenue Collection Agency, that's KRA, and we have seen, with due appreciation to the fact that you are simply at the collection agency, policy comes from the Treasury, but we've seen a number of measures, whether it's presumptive tax, turnover tax, trying to widen this net into the informal economy. How is it looking like, especially in this COVID-19 environment?
Thank you, Amboko. I want to first of all say that from the place where I sit as a tax policy expert, I have two challenges. One of them is to ensure that we create a good environment for businesses and investments. The other issue that we need to balance this, we need to ensure that also the government gets enough revenue to manage its resources. These are the two aspects that we look from the policy perspective. And in doing this, we need to consider one important thing, that we ensure that every taxpayer pays a fair share of their taxes, to ensure that we ensure equity among the taxpayers and also fairness. And the basic driving factor is expanding the base beyond the traditional structural tax policies that have been practiced over the years. If you note from the recent legislation that we've passed, you see clearly the effort to reduce the tax burden and ensure there is fairness in the tax system. Specifically, I want to say that one of the areas that we need to focus on as a developing country is the issue of developing new development, particularly in the technology, which has enabled business entities, particularly multinationals, to carry out businesses in jurisdictions, including our own country, without having a physical presence. The second aspect that we look at is how then to formalize the informal sector to ensure that they equally participate in contributing towards the government funding.
Yes.
Those are key issues that we look at, and I believe that most African countries are also struggling with these aspects of ensuring base expansion in terms of taxation.
Commissioner, you sounded like you were trying to preempt us into a conversation on the digital services tax, but we'll be getting onto that later on in this program. I want to switch gears to Robert from the BTeam, which is housed under Safaricom. Robert, first of all, many Kenyans might not be familiar with the BTeam. Just begin by introducing what it does, and let's talk about the subject of compliance of corporate entities as far as this is concerned, because that's a huge subject. And Robert, perhaps you could just move slightly forward as you respond to that question.
Sure. Thank you, Mboko. Thank you very much. So the BTeam is essentially a collection of global chief executive officers who run various businesses around the world. And what these CEOs have done is they've come together to form a collective to really drive their businesses to be a force for good. The BTeam was founded by Jochen Zeitz, who's the former CEO of Puma and now currently the CEO and chairman of the Harley-Davidson motorcycle company, and also Sir Richard Branson from the Virgin Group. And Safaricom is a founding member company of the BTeam, and our late CEO, Bob Collymore, was a board member of the BTeam, having joined the board in 2015. And one of the key areas that BTeam companies around the world have worked towards is how can businesses be more proactive in being responsible citizens in the jurisdictions in which they operate, to pay their fair share of tax. And in doing so, what the BTeam did and the BTeam leaders opted to do was to formulate what we call the BTeam responsible tax principles that essentially define how corporates would behave in a responsible manner when it comes to taxation in their respective jurisdictions. And really looking at fulfilling the social contract that corporates have, not only with the citizens, but the jurisdictions and the governments where they operate.
I see. And with regard to the subject of compliance of taxes from a Kenyan optic, of course, where you sit at Safaricom, you have tons of data and you're definitely a facilitator of a lot of business transactions in Kenya. How are you enabling the country to at least widen the tax net in this regard?
I think, Mboko, if I may just give an example, you do realize that when we do have suppliers in our database, we do expect these suppliers to be compliant, to be tax compliant before we can start working with them. And that also applies to many other large corporates that operate in Kenya. And I think that really ensures compliance when it comes to taxation.
Great. I want to come back to Professor Atia Waris. And Professor, the subject of coherent and predictable tax policy has really surfaced thus far in this conversation. To the best of my knowledge, I might be wrong, Kenya does not have a tax policy as yet. It's something which has been discussed, but is still in the making. To what degree does this hamper the extent to which we can finance Africa sustainably?
So you can piece together Kenya's tax policy from multiple documents, treaties, legislation, but also government policy like Vision 2030. But you also have to tap into, for example, Vision 2063. So you have to look at regional documentation as well as continental documentation in order to pull it together. Unfortunately, there isn't any document in the public domain that we can actually look at. And It's there for several reasons. Any country that has a loan from, for example, the Bretton Woods institutions like the IMF, don't actually get a lot of control on tax policy. Very often, tax policy is dictated based on the loans that you've taken on board. And so the likelihood of even having a coherent tax policy on a regular basis is hampered by wherever you've received a loan from. But be that as it may, the absence of a document like that gives a lot of difficulty in allowing populations to understand the direction their country is trying to take. And I think the most important thing that our government should do, but across the continent, is to start having very coherent expenditure and revenue policies. So it has to be both sides of the fence so that people can actually understand what's going on. And if we were 20 years earlier, our populations were not that literate. But now across the continent, we are hitting 70, 80% literacy in many countries. And people want to know what government is doing with the money and how it's spending it. And so this hampers the ability of a government not only to be effective, but it hampers the ability of the government to have trust from its people. And trust is crucial, especially in times of emergency. So for example, we're in a pandemic right now, and lack of information is probably undermining the ability of government in many African countries to actually roll out what might be really good interventions, simply because they've not developed trust between their populations and their governments in the past.
Christine, just before we take a break, and really on this subject of a tax policy, we have seen a scenario whereby the tax framework keeps changing depending on where we think we can get more revenue from, whether it is presumptive tax or minimum tax as it is now proposed, or venturing into the digital services tax. How do you see this landscape when it comes to the question of a tax policy? Oh, Christine, we seem to be having a challenge in terms of getting your audio. Maybe I should just... oh, yeah, I can hear you now. Please proceed.
Yes, so Amboko, that's a very good question. And this is because most of times we have tax policies that are driven by the expenditure. So you have tax proposals that are coming in place because they want to drive the expenditure we need to collect. What that does is that it really affects investor confidence. Investors do not feel like our tax policies are consistent, that they are predictable, and they're very unstable. That's why you see some proposals that are given, like some rebates, for example, to the energy sector, being reversed within a very short time, or some concessions given to the recycling sector. You can imagine you've had investors who put in their money there because of the lower corporate tax rate, because of the exemption of some of the supplies from an importation perspective. So when you have this being reversed because there's pressure to now collect, it really affects investor confidence, and it affects the driver for the revenue, because once businesses thrive, because the tax space is good, predictable, and consistent, you'll certainly get the taxes that you're looking for. But the immediate reversals, just because of pressure, certainly affects our economy.
Right, and that point by Christine. And welcome back to the Nation Leadership Forum. Tonight we're focusing on financing Africa with delving into the issue of sustainable taxation. And just to pick some feedback from Twitter, Joel Kipkorir is stating that the challenge of financing Africa is largely about tax compliance, because authorities make the compliance extremely complex and difficult. Commissioner Morris, if you can hear me, this is something which clearly falls under your ambit. The complexity of tax compliance in countries such as Kenya is being cited as a key challenge. What is KRA doing around this area?
Thank you, Manamboko. The issue of tax compliance, particularly within the African countries, yes, it is a situation that is complex in many countries. But I wish to state the case of Kenya, which, as you may be aware, because of leveraging on technology, we have greatly improved the ease of payment of taxes and also filing returns. We are still continuing to improve in areas that might be a challenge to the taxpayers. The other thing that we have done, apart from administrative interventions, is to reform the tax laws to ensure that they are simpler and understandable to the common taxpayer. Particularly what we have done of late in terms of taxation of the informal sector, you see, it provides a simplified way to just calculate the tax based on your turnover. The same applies to the digital tax that we are now introducing and many others. When Amboko, if you allow me, I would like to venture into the area that has just been discussed, if you allow me,
Please.
On the issue of tax policy. First of all, I want to clarify that Kenya has tax policies. The only challenge that is there is that they are scattered within the tax statutes. And if I can say clearly, on the income tax, we have reviewed the tax policy in consultation with other stakeholders, including the Institute of Certified Public Accountants. This is an action that we took in 2017, just before we embarked on the development of the income tax bill. What we need to do going forward is to consolidate these policies to ensure that they are accessible, first of all, and also compact in terms of anybody who wants to go through them. So it is not true that we don't have a tax policy. The only challenge is that they are scattered in in many volumes. I need also to further clarify that in terms of tax certainty, which is a major issue when it comes to business and investment. Yes, many African countries have challenges with the issues of tax certainty and consistency in the tax laws. But I believe that particularly for Kenya, there is a lot that we are doing to ensure that there is limited variation on the law on a yearly basis. When you see a variation in the legislation, particularly look at the current laws, the objective is to venture into these areas where most of the taxpayers have remained either non-compliant or the legislative framework is not clear.
Okay.
And I want to say, just in conclusion, that a tax policy is a living document.
Yes.
It must take into account changes that occur both in international arena and even locally. So you cannot say that you cannot change a tax law or a tax policy. We need to take into account the environmental changes as well. Thank you.
But Maurice, just to hold on to that thought before I move on to Robert, take an example of the proposal in the finance bill, and I know the proposal comes from Treasury, on the minimum tax, whereby the provision, first of all, is that it will be filed, rather they'll be handled on a quarterly basis, when majority of businesses are used to handling income tax on an annual basis. And of course, this has become a matter of contention as to how that will pan out eventually. How do you see it from the revenue collector's optic?
Amboko, let me take this opportunity to educate you a bit. Income taxes are paid on a quarterly basis called installments. They are paid in 4 installments, and it's the same line that you took when we developed the minimum tax. So actually, if you look at the law clearly, you'll find that the minimum tax payment falls on the same date as the installment payment. Thank you.
I see. And Robert, let's look at the role of corporate entities as far as tax compliance is concerned. When you look at it from the larger picture, of course, being at the point where Safaricom is the biggest entity in Kenya, what perhaps can be done to ensure that many more entities are compliant with this, the legislations which are tabled, and of course the taxation?
Thank you, Amboko. That's a great question, and I think businesses realize the fact that they do not exist in a vacuum. They do exist to provide value to their customers, to also work collaboratively with the governments in which they operate in, and therefore they do not exist in a vacuum. And from a matter of compliance, I mean, as far as the law is concerned, tax compliance is from a corporate perspective is non-negotiable. I think what can be negotiated is is the impact on other people within the value chain or other organizations or entities within the value chain. But I do believe that having a positive discourse, perhaps I'll just give you an example, Amboko. I've had the opportunity of working closely with a regional body called the Africa Tax Administration Forum, ATAF, which is essentially a coalition of revenue commissioners from around the continent. And you hear the same story that a lot of revenue agencies across the continent are struggling to meet targets, and in doing so, they need to capture more people within the tax net. And then again, another common ideology that we've picked up from those ATAF discussions is the fact that countries on the continent are competing for foreign direct investment. And so by doing so, they may provide incentives. Country A may provide an incentive that is actually detrimental to what country B is trying to do, because African countries are desperately competing for foreign direct investment. So it does also make sense for revenue authorities to share information, talk to one another, and perhaps also develop strategies that will enable them work collaboratively among each other.
Coming to Professor Tia Waris, there's feedback on Twitter where a gentleman here is saying that financing Africa is more about ensuring there's efficiency in use of the resources which are already mobilized as opposed to widening the tax net. Do you share this sentiment? And perhaps what are your thoughts in terms of the efficiency with which we're using the resources we already raised?
Thank you very much. So one of the premises that I discovered when I was doing my research on the African continent is that there is a problem facing pretty much every African country. And that is that they have been collecting taxes since independence and spending it, but they haven't really been doing a proper case of accountability. So for example, 2 years before elections, very often auditor generals are not getting access to accounts, and then they get them after the new regime comes in, and then they get accounts for the previous regime, but not for the current regime. So this is actually a rhythm that you see happening across the continent. And so actually I agree with the gentleman who has given the comment, because I believe the first place to start is to look at what you've collected and make sure that you're spending it properly before you make any changes on a system. Because the only way people will trust you is if you actually are already implementing the system properly. And I think that there are a lot of people who have different positions on whether it should be expenditure first or revenue first. But I think in the case of our continent, where taxes are still not well understood by many members of the population, or may not even be aware that they are paying taxes across the continent, you really need to embed that into the system. I agree with Maurice about the issue of fairness and expanding the tax base. But my biggest challenge, again, is do you have accountability? And whenever I hear questions about tax compliance, I actually really feel sorry for the revenue authorities across the continent, because financing a state is not just about tax. It's about state-owned enterprises. So for example, Safaricom is a state-owned enterprise. As a result, it makes a profit. Some of that profit comes into government coffers. We need to know what that is. That information needs to be out in the public. So there's state-owned enterprises, there's any other businesses government is involved with, stocks and shares they may be dealing with, any currency trading they are doing, in addition to debt, aid, trade, as well as loans. And I think that a lot of pressure gets put on revenue authorities to deliver, but then the rest of the financing of the budget is not dealt with as much detail as it should be. I'd also like to point out that Robert did raise the issue of the revenue authorities and multinational corporations, but the data that I've collected over the past 15 years only shows that 9 African countries have even released data on the number of multinational corporations they have in their countries. So, we're sitting here thinking, how do we get people to be more compliant? I'd also like to throw a challenge back to African governments. How do we make sure that you're releasing information from your company registries so we even know how many are multinationals, how many are homegrown, what sizes they are, what fields they're working in, and then what kind of exemptions and incentives you're giving them, and whether they're even active or not in a particular country. Thank you.
And Professor, just to be fair to the government and to the entities where the government has a stake, I think they do publish this information. For example, yesterday we had KCB handing over a 2.1 billion shillings check to the government by way of dividends. So perhaps there is, don't you think there's some sufficient disclosure as far as that sort of income is concerned?
So when I talk about the data, I'm actually talking about the entire 54, 55 African countries. And I only was able to get data for 9 African countries, and that doesn't include Kenya. And there is bits and pieces of it coming out, like the example you've just given, but there isn't a coherent data set that we can actually utilize properly. And the problem is that when you're dealing with a population that doesn't know what's happening, you can't give them bits and pieces. You have to give them the full picture so that they understand, so that we move, together, in a very good way. And again, the issue of trust constantly comes up when you're dealing with it. But I will give government credit in Kenya specifically, because the data is getting better and better, and it is becoming clearer and clearer. So for example, the University of Nairobi and Kenya Revenue Authority, we have a partnership where we get access to their data, which is really good for us. And we also do get data from the African Tax Administrators Forum and the African Union in our research team, and that really helps us. But what about the general public? How do you get them on board? And you need to talk to them. You need to communicate better with them.
Okay. And coming to Christine, whenever we talk about financing Africa, one of the subjects which typically pops up is the issue of rationalization of exemptions and other incentives which are normally extended to entities. And perhaps this normally creates some ground for friction, including what you just mentioned in terms of the reversal of some of the rebates that were given to manufacturers last year. But don't you think governments, to be fair, are really struggling with regard to balancing these numbers and ensuring that there is money to finance expenditure?
Okay, so Mboko, so when the incentive came into place, there was a reason as to why it was provided for. And what we've seen with these incentives is that it takes a period of time for you to recoup the benefit of that incentive. So it's expected that in the first few years, you may actually get a tax incentive, but it will result in generating profits in the future for which taxes will be derived. So what we should be looking at is, yes, we need to do a review of the incentives, but we need to give the incentives some time to see whether they give us what we were looking for from a tax collection perspective. And maybe Mboko, I want to speak to the issue of minimum tax that you actually brought about. So the issue we are having with the minimum tax proposal, which is currently in the finance bill, is because it targets 1% of turnover when your installment tax liability is actually less than the 1% turnover. What this means is that even a loss-making company will be required to pay the turnover tax. This is extremely punitive for a loss-making company because companies are in losses for various reasons. During COVID-19, we expect a number of companies to incur losses. Losses may also be attributable to incentives that have been provided, like capital allowances, which now the government has actually slashed to some extent. So requiring them to again pay this without cash flows will affect the workforce. It will affect the opportunity to reinvest in the business, and the multiplier effect of that is a reduction in taxes. Remember, even this company that is in a loss position, it's actually paying PAYE, it's paying withholding taxes, and it's paying VAT. So that's the thinking. When you think about incentives and the proposals, as you try to get a balance, please make it easier for businesses and taxpayers to comply. Maybe just as I clear on this issue, Mboko, I did some research on KQ. So KQ in 2019 had a turnover of 128 billion, but they were in a loss of 12.98 billion. So if you require them to pay the minimum tax, they'll be paying 1.28 billion. That's the 1% of the turnover. They do not have the cash flows. They are laying off employees. So you're losing from a PAYE perspective. You're impacting on the opportunity of that workforce to, their disposable income certainly reduces. That affects their VAT. So what we are saying is that, yes, there's a reason to review the incentives, but because they were put there for a certain purpose, let's just have them there so that they're able to generate the income that we were looking for to drive revenues for government.
But Christine, and really just briefly, the counter narrative to that perhaps would be maybe we should be discussing the wording of the provision as opposed to whether we should have the minimum tax or not. Because perhaps, let's say we've had a company which has made losses for 5 years plus. should we then have a provision which says that in the minimum tax, if you've been making loss for this number of years, then you'll be subject to it vis-a-vis a company which is in a one-off situation because of COVID-19? Don't you think that would be a better bargain?
I wouldn't want it at all, Mboko, because I think there are many reasons as to why a company is in a loss position. But we've actually seen that being taken up by some countries. We have some countries in Africa that have actually said, if you're in a tax loss position for more than 5 years, in the 5th year, you will be required to start accounting for the minimum tax. And the rate is actually lower at the 0.5%. So if this is actually to take in force, I think we need a period for which a company is allowed to be in losses to help it utilize its capital allowances and even consider reducing the 1% to maybe 0.5% or a number lower than 0.5%. 1%, Mboko, assumes that this company is already making margins of more than 1% if they're to pay 1% of this amount as tax.
I see. Definitely the issue of minimum tax is not going away anytime soon. But switching gears to Maurice, and just to get your thoughts, still on the subject of rationalizing tax exemptions, we are now about 6 years since we came up with the new VAT Act, which principally sought to address some of these issues. How are the numbers looking like in terms of what KRA is now able to mop up by way of revenue?
Aboko, thank you very much. I'll come to the issue of the minimum tax, but let me talk about the issue of incentives. Particularly within the context of Africa, one of the major challenges that most African countries face is the issue of tax incentives, financial subsidies, and regulatory exemptions. And the impact of this is that it actually erodes the tax base by creating an expenditure which actually denies the government the revenue that it needs. In the Kenyan context, for example, our tax expenditure has been in the range of almost, actually above 5% of the GDP. That is very high because actually if you look at the other countries, including South Africa, you'll find that the tax expenditure is actually around 2%. So our tax expenditure, even within the African average, is if we compare with the African average, is well above the African average. And that means the government, in terms of ability to fund its expenditure, it is handicapped. So what then should the governments do? The option is not the issue of exemptions or incentives. The right thing is to develop proper tax policies to ensure that the businesses are compensated through appropriate infrastructure and not through tax allocation, the way we have been doing. So that is an area that at least we have relooked at, particularly through the Tax Laws Amendment Act, as well as the Finance Bill 2020. And I believe that we are in the right direction. Mr. Mboko, if you allow me just to comment briefly on the minimum tax.
Please.
I'm surprised that CPA Christine has no issue with the turnover tax, which is at 1% of turnover of the small taxpayer down there. I can inform you that in our country there are companies that have not paid taxes ever since they were established, more than 20 or 30 years. Now, what fairness is it if we now say that the small mamamboga down there in the village must pay tax based on their turnover, yet there are entities that have never paid taxes? And I want to emphasize that it is not only Kenya that is implementing this tax. Over 55 countries all over the world have implemented this tax. And if you look at the rate that we have used, is mostly, I would say, is the lowest. You'll find countries with 3% of the turnover as the minimum tax. You may be aware that even the US had minimum tax based on the asset base.
Yeah.
And I would say that what we have done is not outside the international framework in terms of taxation. Thank you.
Maurice, just a quick rebuttal to what you're saying. Perhaps the question then becomes, when you talk about there are companies which have not been paying tax ever since they were started, then whose fault is it that they haven't been paying tax? Because someone has to ensure there's compliance.
the bottom line issue, Amboko, is not that they have not been paying. The bottom line issue is that we need all persons doing business in Kenya and enjoying the resources to contribute equally in a fair and equitable manner towards government funding. It is not about loss-making companies. Actually, if you look at the legislation, it is not talking about loss-making companies. It is just to ensure that the equitable presumed rate of tax for a company should be at the rate of 1%. So even those companies which might be making minimal losses will be required to pay the minimum tax. And as I said, this is not a Kenyan-only practice. It's internationally recognized. Thank you.
Clearly, we need another NLF discussing minimum tax. Maybe that's a discussion for another day. But switching gears to Robert. Robert, the issue of a stable policy environment has been emerging consistently in this discussion. I'm just curious to know what your thoughts are, especially from the BTeam perspective, and how this impacts the attractability of Kenya as an investment destination.
Thank you, Mboko. Let me just briefly touch on the BTeam responsible principles. We do discuss that it's important for corporates to have open and honest discussions and of course communication with revenue authorities, with customers and other stakeholders in the entire value chain. And therefore, these discussions with revenue authorities would touch on issues around, how do we create tax policies that are favorable for business? How do we create an environment that is equitable? Of course, touching on the various key aspects of a good tax policy, and perhaps I know in a country such as ours, we've been reviewing incentives that we've had in the past for a long time. Since the early 90s, Kenya had hinged on the export processing zones, for example, as a way of attracting foreign direct investment into Kenya. We've now transitioned that into the special economic zones, and that really comes about from having a healthy discussion between corporates, the policymakers, and the revenue authorities, so that we have a system that is thought through and a system that is really geared for transitioning a country such as Kenya into the next level of development. It's not always easy, but I think it's important for corporates and the tax authorities, civil society, and others to have healthy discussions on generating a tax policy that makes sense for everybody.
All right, and that point by Robert takes us to our second break on this discussion of Nation Leadership Forum, where we are delving into the subject of financing Africa, looking at sustainable taxation. We'll be right back with a lot more on this subject. Welcome back to the Nation Leadership Forum. Tonight we are focusing on financing Africa's sustainable taxation. Before we get into that conversation, news developing is that Kenya wins the UN Security Council seat after garnering 129 votes against Djibouti's 62 votes in the second round of voting. Just to say that again, Kenya wins United Nations Security Council seat after garnering 129 votes against Djibouti's 62 in the second round of voting. So definitely that's something which many Kenyans would be proud of. Let's just see how this develops in the days ahead. But coming back to the discussion in studio where we are focusing on financing Africa's sustainable taxation, Professor Atiye Waris, some thoughts on some of the comments which have been mentioned by the panelists regarding issues of incentives.
So I found it very interesting the way the conversation was developing on incentives for companies. So it's really important to understand that companies operating on the African continent have been undergoing a double-digit profit predominantly. And I'm giving you broad statistics at this point in time. But what is also important to remember is that many of them are turning a profit within the first year. And those declaring losses are not really declaring losses. And I'll explain what I mean by they are playing games with their financial systems. Now, when we argue for tax incentives, the traditional Western model of a business is that you need 5 years to turn a profit. And that is where things like tax incentives through tax holidays, where you give a 5-year tax break, doesn't make logical sense. Why will I give you a tax break when I know you're going to be loss-making for 5 years anyway? I should just leave you alone, let you stabilize, watch you process, and then after 5 years, if you still need help, then we give you your incentives. But stabilize, declare honestly and openly, and then we see where you go from there. And I think that is where tax holidays or incentives tend to get misplaced. And I join myself to Morris's argument, but I'm going to add a little nuance. When you're talking about domestic, like purely domestic companies, then Revenue Authority is able to monitor them. But when you talk about a multinational corporation, suddenly it's a whole new ballgame, because accounts are only registered in one country. So the headquarters country is where it is registered. They only register what are called consolidated books of accounts, which means that the only country that truly understands how much tax is being paid is the country where the headquarters are actually located. So you've seen a lot of like international debates and discussions where, for example, in the US, they are demanding that American companies must come back onshore and not be offshore. And the reason for that debate is because a lot of companies actually shifted themselves onto what we call tax havens or secrecy jurisdictions. And even on the African continent, we have countries that give preferential tax rates. Countries like Morocco, Mauritius, South Africa. And once we roll it out completely, it is expected for the Nairobi International Financial Center, although it is not yet clear how that is operating yet. So all of these spaces, and there are others, actually provide preferential treatment for multinationals. So you don't even know if that loss is an actual real loss. And that is actually why there is this pushback for a minimum tax, because governments don't trust multinational corporations. And the continent has been seeing struggles. Actually, it's a global problem. You hear scandals like Swiss leaks and Panama leaks, and there have been Kenyans implicated in a lot of those scandals. And if you see that and I think that's why I keep coming back to, it's a question of the trust a society has, and it needs all stakeholders. There's a lovely Congolese proverb that says that a single bracelet doesn't jingle. I should have worn a bracelet today, but anyway. And that's because if you don't bring all your stakeholders together, then they don't mesh, and then you don't have a holistic solution. And I think it's really important that we don't leave anyone out, which is what Robert is talking about, but we also have to be very aware of those stakeholders that are less than honest.
Right, and just to hold into that thought, Professor, in his budget speech this year, the Treasury Secretary, Cabinet Secretary, I should say, Ukur Yatani, did indicate that there's a process of rationalizing all these incentives, because in his estimation, or the Treasury's estimation, the government was losing about 535 billion shillings. And I'm picking that from his speech, not from my own thinking. And just to cross over to Christine, on the subject of digital taxes, this is one area which has been widely touted, and of course Maurice did allude to it when he was starting. What are your thoughts around this, and how can this help the continent or derail the continent as far as financing itself is concerned?
Okay, so I think this one was good for purposes of widening the tax base, and it takes into account the fact that previously taxes were mainly designed for physical presence, but with the advancement of technology, we are seeing a lot of goods and services being transferred across without moving from one jurisdiction to another. So that will certainly help in improving the tax base and widening it. I think the issue is we need to ensure that the proposals that are being passed through are actually targeting the base that we hope to get the income from. So case in point, the digital tax place is mainly targeted at the intermediary platform service providers. So you need to ensure that these people who we want to target to subject this tax to, it will not result into double taxation. They'll get the credit of any taxes that they get to pay. In respect to non-residents, I think, which is the primary target for this, we need to ensure that the compliance with digital tax will be an easy way for them to comply, so that we can be able to bring this income and subject it to tax in Kenya. That for me, Maurice, you know I'm for the digital tax, but I just want to ensure that it is done in the right way to avoid double taxation, to avoid subjecting the same income to tax twice, and also to avoid issues that will result into non-compliance.
Maurice, you've definitely been preempted there. Just to get your thoughts on how this will actually work out. Of course, we have seen the regulations coming from the Treasury to try and work out some of the kinks, but just give us your sense around this whole subject of digital services tax.
Thank you, Amboko. The genesis of digital tax is largely because of new business rules, particularly surrounding digital economy. most of the transactions are increasingly being transacted over digital platforms. Because of lack of presence, which CPA Christine has mentioned, it becomes very difficult to tax these entities. Therefore, they create value from Kenya, but they don't pay their fair share of taxes. This is not a Kenyan problem or an African problem. It is an international problem. So what then should be done is to ensure that the international tax rules are changed. And the debate is already going on. There are preliminary recommendations that have been made. What is important for a country is to domesticate those rules that have been developed at international level. Africa is a big participant in this engagement, particularly through the African Tax Administration Forum. And the basis of our legislative provisions are largely domesticated from the engagement at international level. And I'm happy that it's a tax that is accepted generally by the Kenyans, because it actually creates fairness and equity amongst taxpayers. Why should you have somebody coming to do business in Kenya here, doesn't pay taxes, yet we push the local residents to pay taxes? It creates unfair, distorted market for the local taxpayers. Thank you.
All right. Robert, to come to you just to get your thoughts on the proposed digital services tax. And there's someone on Twitter who's asking, what precisely is the BTeam doing to support SMEs and ensure their compliance regarding taxation?
Mboko, I'll take your first question. And I recall when the BTeam put together the responsible tax principles, the greatest resistance that we faced was actually from multinationals that are domiciled in the that are US based companies. Really, the big US multinationals would not sign, they would not respond to the tax principles, and as we shift into this narrative of digital taxation, which is now globally accepted, you'll find that many of the large multinationals that will be affected are actually American companies. And I've been reading quite a bit of discourse on the fact that the U.S. government itself would perhaps find that as a punitive trade measure if digital taxes were to be enacted in certain jurisdictions, and would look at maybe punitive measures. But again, that's a discourse that needs to happen at some point. But I do know that when we put together the global BTeam responsible tax principles, the biggest resistance really came from U.S. multinationals who've been slow to sign up to them. Now, in terms of what the BTeam specifically is doing on supporting SMEs in this discourse, we work with partners. We work with various partners across the board. We work with institutions such as the B Corp movement, which is another aspect another entity that is more geared towards SMEs around the world. You'll find that membership of BTeam of the BTeam companies is primarily larger companies, but within their supply chain, they do work with hundreds of thousands of SMEs, depending on who you're talking to. Some of the BTeam companies today include companies such as Salesforce in the US, Allianz in Germany, of course Safaricom, the Kenya Commercial Bank here in East Africa. So we have large corporates that do have hundreds of thousands of SMEs within their supply chain, and it is expected, of course, that by engaging with these corporates, the SMEs are also able to pick up on the ethos of running sustainable businesses.
All right. And coming back to Professor Atia Waris, reading through reports from the World Bank, IFDB and the likes, the subject of necessitating fiscal decentralization is emerging about financing Africa. And the issue is, in countries such as Kenya, where we have two levels of government, how can we best ensure that the county governments, for example, are playing an equally significant role as far as ensuring, one, that compliance is enhanced from a tax perspective? And when I look at the Kenyan framework, for example, it comes to me like this is something we have tried with the presumptive tax. Just to get your thoughts on how this can help Africa in financing itself.
So thank you very much. That is actually probably one of the most complex questions you can now deal with when it comes to the African continent. Firstly, because we're supposed to move to an African continental free trade area, and we are trying to move into a federal African state or a union of African states, which means that every country turns actually into, as it is, a county, if you want to use Kenyan language. And the result of that is we are going to have multiple tiers of governance, and all of them are going to need financing. And there are going to be a lot of problems in compliance. So let's start from the bottom, which is the grassroots. One of the challenges that I've seen happening in Kenya is that we may have administratively decentralized, but we did not financially decentralize. And the reason I say that is because a lot of the people are working, for example, in your healthcare system down at the counties, but the salaries are still coming in from national government. Now, when you don't devolve the finances, then you don't give that sort of county area independent control, it doesn't know how to actually roll out issues. Now, we are slowly trying to make way towards making that a stronger system down at the county level, but it's caused consistent problems between already central government in Kenya and the county governments. Now, if you transpose this onto the African continent, and you talk about things like digital taxation or multinational corporations operating across borders, then you have that additional problem of, say, Unilever or Coca-Cola. Coca-Cola is across the continent. So you have this one company operating in multiple countries that are now going to have to produce accounts that allow you to now redistribute because we've opened up the borders. So having clear formulas on sharing is really important. And I say this because you need it at county level within the country as it goes to the federal level. And then you also need it as we move into this African continental free trade area. And one of the ways I think you can already start to do it is counties are already registering businesses in their areas. And this data needs to get to the Revenue Authority. Revenue Authority needs to get them registered with TIN numbers. I found it quite fascinating. I think it was a month ago, the Kenya Association of Manufacturers released data on SMEs and said that I think there were almost 1 million or 2 million plus SMEs in the country. But at the same time, my data from Kenya Revenue said that there are only about 964,000 odd registered companies in the country. So suddenly you have this disparity in data, and I have a feeling it is because of the number of companies operating in counties. So we need to have that system in place, working gently and nicely. And I think if we were to give tax incentives, we need to give breaks to companies that are starting to set up and headquarter themselves in counties very, very quickly, to stabilize them and then give them time to come onto the tax net.
And Christine, just to get your thoughts on the same subject, because of course we know there are already efforts by entities such as the Revenue Authority in terms of ensuring that there is this seamless flow of information between all agencies of government to ensure that these numbers are, of course, quite consistent across the borders when it comes to collection of revenue.
Okay, so I think collection of revenue, when you have proper numbers, you're able to determine where the leakage is from a revenue perspective. But Mboko, I think what the government needs to do is to ensure that it's accountable, to ensure that it can be able to support its expenditure. Because I can give you a case in point, Mboko. We've got lots of pending bills for SMEs. These SMEs are in the county level and in the national government level. Pending bills, what does that do for the SMEs? It affects their cash flows. In some instances, some of the services that they've rendered to the government, they've actually had to pay the VAT out of pocket, because you pay VAT whether you've been paid by the purchaser of the services or goods or not. So what's happening is that these SMEs are really put in a very tricky position because they've had to pay a cash outflow for amounts of monies that the government hasn't paid them. This spans over a period of 2 to 3 years. So even as we think at holding counties accountable in raising revenue, I think what it needs to first do is to create an environment for these SMEs to thrive. Because even if we set up those businesses there and we provide them with incentives, if their first consumer of services is the government and the government still doesn't pay them on time, these SMEs will not thrive. And because of that, their tax obligations cannot be met. and they will not be able to create this widen. We cannot easily put them in the tax base that we hope to widen. They won't be motivated to pay any additional taxes. So I think that it's an issue that government has to drive. From an accountability perspective, tell us about how they're using the funds so that can motivate different corporates and individuals to pay taxes accordingly.
I mean, I wish we had someone from the National Treasury just to respond to the issues of accountability. But moving on to Maurice. Maurice, I'm sure you have some thoughts you can share with us around the whole issue of how you are coordinating with county governments to ensure at least these efforts are stepped up as far as revenue mobilization is concerned.
Thank you, Amboko. One of the things that is important for us from a tax administration perspective is to ensure efficiency and effectiveness in our systems. Not only coordinating with the county governments, but there are other bodies and also even other government agencies. And effectively, by leveraging on technology, we have ensured that we have a wide network in terms of managing compliance. The engagement with the county government is at higher level, and what we expect to achieve once all the county governments are also fully automated will be amazing in terms of mobilizing the domestic revenue. Thank you.
Thank you. And Robert, just your sense around this issue of reaching to the very businesses at the bottom of the pyramid, especially at the county level where they might not have all the information or all the access they might need to do their compliance and ensure that they're paying their taxes as required. What would you recommend to be done from a private sector perspective?
Mboko, thank you. I'll zoom in on the word sustainable. And really, when we talk about sustainable taxation, we are talking about the realization of rights. These businesses do expect that they will realize some form of rights through sustainable taxation. And therefore, it's important that there is trust between the businesses and the policymaker. And as the policymaker is focused on the collection and administration of taxes, the business has to trust and believe that other entities or forces outside of this taxation system do not influence, tax collection, and whether that is corruption, bribery, so that there's full trust between the business and the tax policy administrators and collectors. And I think once we get closer to that point, then of course you will expect that there will be greater compliance among SMEs operating at the county level, even those at the national level. And just to touch on an issue that Christine mentioned around pending bills, I think it's a very difficult conversation to have with a business, especially a small business, that has a certain amount of money outstanding as a pending bill, both at the county level and the national level, and also really pushing them to be compliant when that discussion has not been had. You're putting them between a rock and a stone, and we do have thousands of businesses in this country that are stuck in that position, which is tough.
All right. Many thanks, Robert. And I'm told by my news director that we have about 3 minutes to the close of the conversation. Let me just begin by wrapping up thoughts from Christine in terms of what your outlook looks like regarding financing Africa from a sustainable optic.
Okay, thank you. So for me, I think we should be focusing on how to create an environment that will thrive so that businesses can thrive. If we do that, we expect to see an increase in taxes, and guys will, corporates and businesses and individuals will feel the motivation to pay. If government cannot be held accountable for the funds that they actually collect, it becomes very difficult to improve the compliance perspective from the informal sector. So I think for me that's the highlight on tax collection.
Commissioner Maurice, your closing thoughts regarding this subject?
Thank you very much. For Africa, I would say that there is a great opportunity for us to enhance our tax policy in terms of improving them, particularly in these times of crisis. There's need to focus on issues that will add value, particularly taking into account the fact that the official development assistance is actually dwindling. The loans are more expensive. I think the alternative is to mobilize internal domestic resources and taxes for that matter. the opportunities are many. Thank you.
Robert, your wrapping up thoughts?
Thank you, Mboko. I think just to recognize the fact that corporates do not only play a role in contributing to the tax revenue of a country, but also to the socio-economic development of the country, and also fulfilling the social contract with citizens and other stakeholders. I think it's important to understand that whole genesis. Thank you.
Right, Professor Tia Waris will be giving us the final thoughts. And Professor Tia, I have a question for you. Having read your book, is it still relevant in the COVID-19 environment?
Thank you, Julian. Yes, it is absolutely valid. I actually read my book again just to make sure today. And I will tell you that all the vulnerabilities that we've been talking about within the tax system are actually being exacerbated. They're becoming highlighted, not only in Kenya and in Africa, but it's a problem happening across the globe. And so a lot of the challenges that I've identified, you now actually see them even more clearly. The lack of accountability or transparency, lack of knowledge on emergency funds that countries have and how money is being utilized and if it's being utilized properly. But also at the same time, the weaknesses in governance systems start showing themselves up, as well as the economy, the ability of people to move quickly onto online systems and then avoid being part of society and contributing to it. And I think that if there is one thing I think we have to be very careful of in this COVID era and the post-COVID era, it's to say that we cannot benchmark anymore. We need to be innovative. We need to think out of the box. And one of the biggest concerns and challenges I think we are facing is that if we continue to look at countries in the global north and say this is the international benchmark and therefore we're going to do it, we're going to be faced with the same problem over and over again.
All right.
We need to understand our people. Thank you.
Many thanks, Professor Tia Waris, and many thanks to the entire panel for being with us on this Nation Leadership Forum. We have been discussing financing Africa, sustainable taxation, and many thanks to you for your feedback on Twitter. Don't go too far. NTV News is up next.